Hello, my name is Sarah Beysselance, and I'm doing my financial analysis, comparing two industries with 5 companies each. Now, my two industries are casual restaurants and oil and gas. For casual restaurants, I'm comparing Buffalo Wild Wings, Cracker Barrel, Red Robin Gourmet Burgers, Cheesecake Factory, and Ruby Tuesday. For the oil and gas industry, I'm comparing Exxon, Chevron, ConocoPhillips, Marathon Oil, and Hess. Now, the first thing that we're going to look at is the economic value added spread. What the economic value added spread is the company's return on investment capital minus their WACC. We look for a very high EVA spread because this will show that they have positive growth in their company, they have the ability to give back, and they have high profitability from their investors. As you can see, 3 out of our 5 companies have negative EVA spreads, which is not a positive thing that we look for. But what I'm going to do is get rid of the absolute lowest one that's already gone, and that's Ruby Tuesday with a negative 16.05%. Now, looking at this spread from Bloomberg Lab, you can see that they have 52% of their capital is in long-term debt, 45% is in market capital, and 2.4% is in short-term debt. That puts 45% equity and 54.8% in debt. That gives them a WACC of 5.6%. And the return on investment capital was already a negative 10.48%. And when you take this subtraction, that's how you get their EVA spread of a negative 16.05%, which you can see down here. Now we're going to look at the casual restaurant that had the highest EVA spread, and that is Cheesecake Factory. Cheesecake Factory had an EVA spread of a positive 16.44%. That is almost the exact opposite of Ruby Tuesday. Now to see why, you can see that 100% of their capital structure is in market capital or in equity. That's what gave them the 7.4% WACC. And their return on investment capital was a high positive 23.87%. And when you take that subtraction, that's where you get your EVA spread of 16.44%. Now looking at the return on equity, or ROE, the main goal in management is to maximize shareholder wealth. So when we look for the ROE, we're trying to see, is the company giving back to the shareholders? If so, how much? Is it enough? Should they be giving more? So we're looking for a high ROE and possibly a rising ROE as well. So looking at our 4 companies that are left, Buffalo Wild Wings, Cracker Barrel, Red Robin, and Cheesecake Factory, you can see that Cracker Barrel is way up here compared to everybody else with the highest ROE, and is having a positive growth over the past few years. Now, you can also see that Red Robin and Cheesecake Factory have been also having positive growth, but Buffalo Wild Wings has had negative growth, so we're going to get rid of those. You can see with this line here, it drop off. Now we're going to look at their EBIT margins. We want a positive EBIT margin, we want a growing EBIT margin, but as you can see with Red Robin, we don't have that. We don't have a constant. We don't have a growing. They had a dramatic drop off from 2011 to 2012. They tried to bring themselves back, but they never reached the height of Cracker Barrel and Red Robin. So Cheesecake Factory is going to be out. So breaking down the ROE. ROE can be calculated by ROA times equity multiplier. Then you break down the ROA, which is profit margin times total asset turnover, which now the profit margin can be broken down into tax burden times interest burden times equity margin. What runs the ROE, though, is the total asset turnover and the EBIT margin, because those are the only 2 things a company can truly control. Now, to look at the total asset turnovers for 2 companies that are left, which is Cracker Barrel and Cheesecake Factory, we want a positive total asset turnover, either constant or growing. And as you can see here, Cracker Barrel has been above Cheesecake Factory all these years. but Cheesecake Factory has been growing. For their equity margin, again, for their equity margin, it's the exact opposite. We want this is their leverage. We want them to get rid of debt. As you can see with Cracker Barrel, they have tried to get rid of a lot of their debt, and they truly have, and they've come down a long ways. But Cheesecake Factory, they've been pretty constant, but they've been lower than Cracker Barrel this whole entire time. So that's a plus for Cheesecake Factory. That's a good view. We like to see that. For their profit margin, Cracker Barrel has been at a constant growth. They have gone above and beyond. They have overdone Cheesecake Factory in between 2013 and 2014. For Cheesecake Factory, they were doing well. They were above Cracker Barrel until about 2013 is when they started declining, and they are below Cracker Barrel at this point, which means that Cracker Barrel is our winner in the casual restaurants because they had a higher EBIT margin. They had higher and more consistent total asset turnovers. Their ROE is rising. And they have a higher profit margin. Even though the Cheesecake Factory had lower leverage or lower equity margin, they did not compare with how well Cracker Barrel was with being higher and more consistent in all other categories. Now, looking more into Cracker Barrel, you can see with Cracker Barrel, their long-term debt, looking at everything from their total debt ratio, their debt to equity, and the equity multiplier, they have been constantly decreasing, trying to get rid of that long-term debt over these past 5 years. Their price to equity ratio has been going up, has positive trend, which we'd like to see. Their market to book, it's been going up and down, but at the most part, it has been going up. It has picked back up in this past year. It's been a positive. Looking into the supply chain, they only have 7 suppliers, which does not seem like a lot, but they do not put all their eggs in one basket. For example, with Performance Food groceries, they have the revenue is only 2.05%, and the cost of goods sold is only 12.11%. So they really try to balance out how much they distribute with their supply chain. And their enterprise value has constantly risen over the past 5 years, which is another good thing that we look for. Now, moving on to the oil and gas industry, we have Exxon, Chevron, ConocoPhillips, Marathon Oil, and Hess. Looking at their EVA spread, they all have negatives, which we hate that. We do not like the negatives at all. But what I'm going to do is get rid of the ones that is the furthest down, which is Hess. As you can see with the Bloomberg, Hess had a negative 22.11%. EVA spread, and as you can see, they have 65.5% of their capital in equity. They have 6.2% in preferred equity. They have 2.6% in short-term debt and 25.7% in long-term debt. And this is what developed their WACC of 9.5%. And their return on investment capital was at a negative 12.65%. That's how they got the EVA spread as low as negative 22.11%. Looking at the highest for oil and gas was Exxon with a negative 6.0%. Exxon had 88% of their capital in equity. They had 7.1% in long-term debt and 4.2% in short-term debt. Their WACC was 8%. Their return on investment capital, though, was a positive 1.87%. Now, looking at the return on equity, or the ROE, for Exxon, Chevron, ConocoPhillips, and Marathon Oil, they all start declining, and we do not like that for any of them. But ConocoPhillips and Marathon Oil, they both go into the negatives, so they are out our run for which company is best. Now, moving on to the EBIT margin, you can see that we want a positive EBIT margin, but these two companies, Exxon and Chevron, are both declining. And with that, you can see we don't like that, but you can see that Exxon at the end is above Chevron. And Chevron is decreasing at a faster pace. Again, this is the breaking down of ROE, and what drives it is the total asset turnover and the EBIT margin. For the total asset turnover, you can see that Exxon they're both decreasing again, but Exxon is above Chevron, which is a good thing. We want that. We want it to be higher. We don't like the fact that they're both going downward. They're both declining, but we do like that Exxon is above Chevron. Looking at the equity multiplier for oil and gas is we want a lower leverage. They've both been pretty constant though, but Chevron definitely looks better in this one just because it is slightly lower than Exxon, but they both have been constant over the past 5 years. Now looking at the profit margin, Chevron, you think, they've been above, they've been doing better until 2014 hit, and then they just had a dramatic drop and have not been increasing since. With Exxon though, they have been doing ups and downs, same as Chevron, but they have not had that dramatic drop, and they have tried to come back. So the winner is Exxon, with having a higher EVA spread, having a higher ROE, their EBIT margin is increasing, and having a higher profit margin. Now Chevron has a higher total asset turnover and lower leverage, but their profit margin has been constantly downfalling. Now looking more into Exxon, you can see with their short-term debt that it has been decreasing over the past 5 years. You can also see that with their equity multiplier, they have been trying to decrease their leverage over the past 5 years. Now with their PE ratio, they have been positive. They've been increasing over the past 5 years, and that's a good sign. We like to see the price over equity to increase. With their market to book, it had been declining since 2013, but it's has not declined rapidly. Now to look at their supply chain, you can see that they have 361 suppliers. But they definitely keep everything in 98 customers over here is what this shows. They definitely keep everything distributed though. And for example, over here you see Seadrill, and they have 14% revenue and 2.5% CapEx. So they keep everything separated. The highest amount you'd see is with Parker with a 39.2%. The enterprise value for Exxon has been positive again in 2013 to today. It has a slow decline, but it has not been dramatic, and they're pretty much back to where they were 5 years ago. Now, comparing the two winners, Exxon and Cracker Barrel. Comparing their EVA spread, you just want to get rid of Exxon right away because they have a negative 6%, where compared to Cracker Barrel, they have a positive 14.94%. If you remember, we want a positive EVA spread. We want that high positive percentage. Comparing their ROEs, again, we wanted to look for a growing one, a rising, a positive, and Cracker Barrel is doing that. Yes, they had this slight decline for a few years, but they brought themselves back up, and they're doing well. For Exxon, though, it's the opposite. They have been declining and declining more and more every year. For their EBIT margin, Exxon, at first you're like, oh yes, Exxon's doing better than Cracker Barrel, but Exxon has been decreasing so dramatically that is going below Cracker Barrel. It is passing it up early 2015 and will be completely passed it up below it in 2016. For Cracker Barrel, it's slowly increasing, but we rather a slow increase than a decrease. For the total asset turnover, there's no doubt Cracker Barrel is winning in this round with its constant, but it's a high positive. Compared to Exxon's, it's declining over the past 5 years. There's no constant, there's no rising, just declining. Their equity margin or their leverage, we can see again that Cracker Barrel has been trying to get rid of a lot of their leverage, and they have succeeded, and now they're on a constant path. For Exxon, they have been steady with their leverage, which is not a bad thing, but they have not tried. It doesn't look like they've decreased at all over the past 5 years, and they're not that far a difference. This is between 2 and 3. They're not that far apart from each other, but again, Exxon does look better just because it is a little bit lower, but Cracker Barrel over the long run, they have been decreasing it, which is a positive lookout for it. For their profit margin, again, Exxon they were rising and then they had these downfalls and are at a constant fall right now. Cracker Barrel, on the other hand, has been increasing over the past 5 years. No downfall, no decrease, not even a little bit. Has constantly been rising and is going to pass up Exxon by 2016. And Cracker Barrel is our winner. Now, looking at one more thing, we're going to look at the dividend discount model for Cracker Barrel. And with this model, if you go off of this theory, the price of their stock should be at $222.47. But in reality, today's stock price is at $167.06. So if you go off of this theory and this model and you believe that it's the right thing, then you should just be stocking up in Cracker Barrel because soon it should be going up to $50 or more.